Alright guys, good morning. How are you all? Good. I spoke to most of you guys, so hopefully you guys online are all good. Before we start today, I wanted to bring up the S&P close from yesterday. A couple of guys here had asked about what happened, because I'd said I'm going to come back and trade the close last night. I know that a couple of other people have done the same, were doing it the previous day as well. It's generally a theme. If the S&P gets very, very busy, the closes are usually at least interesting. You can't say it's going to be great and there's going to be money to be made, but it's at least interesting. Now, quickest thing for me to give a clue as to whether a close the previous day has at least been worth considering, or whether it's worth considering the next day. One, volatility on the day, but two, if you look at the volume on that final minute. So you're averaging coming into the close, this is around about 10,000 lots a minute. The actual close, yesterday's close, did about 65,000 lots in a minute. The close the day before did 120,000. That's big. That's a very, very big close. Typical closes, you will see sort of a spike up in volume, but you might be sort of seeing 30, 40,000 done in the final minute. That could be trade that's done literally over a handle range, could do about that much. So they're the ones that I don't think you do need to be coming in for. But when you're starting seeing it getting over 60,000, that's something worth taking a little bit of note of. So that's the first thing, or the easiest way to sort of, even once you got the replay, at least go back and say to yourself, right, I'm going to go and have a little look at this, see what happened, see if there's any trade to be done on it. Now, we're going to do this in a bit more detail in price action week anyway, looking at specific events that offer very much price action based trade, because whilst there's a decent chunk of volume in this, you can't tell what way it's going to go. One day it will go down and it will just continue down 5, 6, 7 handles. Another day it will chop up and down the two handle range, and still do the same amount of volume. So it's, the skill comes in realizing that it's either going to continue or it's going to be one that is going to come back and forward on you. If it's going to do that, it makes it quite difficult, in the sense that the idea of the trade is that you get in and you play with a continuation until 9 o'clock. So I'll play this. This is what the replay software looks like, by the way. I know some of you have used what's it called? Jigsaw in the past, so this won't be too much of a surprise to you. But in terms of areas that we trade to, I think, yeah, I've got about enough space on the ladder to do it. Effectively, we trade down as far as 84s, and we trade up as far as 96s. So that's a big range for a close. Generally, the activity doesn't really pick up till the final minute, so I have to keep jumping over here to see what time we're on. And 3 minutes to go at the minute. And this is pretty much the kind of price action we were seeing all afternoon. It would skip one way, it would hold a little bit, it'd skip back the other way, it would hold a little bit, it'd skip. So what you're waiting for is when you get some kind of direction. And we're still waiting for that at the minute. So we've gone up. What I try and do as well is coming into it as you're watching those last couple of minutes, or the last minutes prior to the close, just little areas that it's reached up to. So 92 seems to be about the peak of where it's actually getting up to at the minute. And then it's pulling back, and really it's only pulling back to around about 90. So that's almost your two handle range prior to the close. That if we get a move out of that, potentially that could be a little indication that we're going to start getting a move. So we've got just under 2 minutes to go now, and still not too much going on. And that's something, that kind of little action there where it just picks up that little bit of speed, that's the kind of thing that can sucker you in a little bit. Jumps up, now we're above 92, and this is where you think, yep, we could potentially be going for a bit of a move higher. You're still not seeing that much extra volume in it. And I'll point out, I think this was the point where I was starting to think, yeah, you want to go short now. Oh, tried to trade it there on there. Because the fact it went through 92, dropped, and you started to see it sort of coming off through that area, you could try and sell the 90s. Get quite a quick move down. We get as far as 85s, 84s. And that was all because we failed at 92s, dropped back into that mini range. And now we start coming back up. We're now into the final minute. So this is where you really expect the actual activity. I can't delete those. And then you get a 2000 lot. So you can see this 2000 here. He then starts to actually move up, and you can add in front of him as he moves up. The aim being that hopefully it shouldn't fill him, and if it starts to, then you get out. And in this instance, and this is what caught me out yesterday, that as he got filled, it didn't really come back very far. So the trade, when you see something like that, particularly as you had sort of 2,500 that was notably larger than anything else there, it's a very, very quick front run. You get in front of it, the market generally will move away, and then this is the kind of thing you end up, Jigsaw can't quite keep up with the amount of volume. But what happens, as it ticks 9 o'clock, you will get a final sort of push of orders that goes into the market, and that's where Jigsaw couldn't quite keep up with that, and that creates this very quick jump up and down. Generally, that's a fadeable jump up and down, in the sense that as it skips up, you try and sell into that sort of flush higher, sell into that and look for a quick drop back down. You're not looking for miles on that. You're not sort of thinking, I sell 96 and run it back down here. You're looking for up, filled, and as it comes off, out. That's generally the trade. So this was a reasonably good one. It was just a shame that it started to show direction one way and then turned it round the other. So chances are, unless you were very quick, you could have got out down here and back in front of that 2000 for the move up. The 2000 then caught you out because it got filled at 89 3/4, dropped down, and then the buying continued.
Yeah. Don't you want him to get filled, because then it will push?
You don't really, because if he's not getting filled, people will still keep buying it until he gets filled. And so the idea is that as it comes down and fills him, you want to actually sell to him, because effectively what he's doing by pushing that order up is artificially pushing the market higher. Not that there's anything illegal about that. He wants them. He got them in the end. He's just willing to pay higher and higher price for them. So the idea is you can front run that and get out once, particularly when he moves it up. If he keeps moving it up, there's going to be a point where people will think actually it's value to sell to him now.
Yeah.
And that's what you saw. He sort of moved it up from about 86s up to 89s, and then very quickly he got hit and he was down to 900 lots. So that's the kind of thing that you're looking out for. You're looking out to see, as he gets filled, you can then sell to him with the expectation that he'll go through the other 900, and then everyone else who's done the same thing as you and front run him will get out. And if you're quicker than them, they'll have to sell lower. You can then buy it back. And again, that's not a trade that's for a turn in the market. That's a trade for a turn in the very current action. So as soon as it drops, I'm looking to get out, because the fact that there is always a risk that he's got another 2,500 and it goes drop and he goes bang 2,500 more, and then the market goes again. So you can end up with a situation where you go long, short again.
Yeah.
So that was quite a nice example, that 2,500 there. Just the speed that he came in and the fact that he was the only big order in the market. There was nothing else really anywhere near that. And so that very quickly caused a bit of panic. It'd be the same thing as if you saw in, I don't know, say the DAX, you've got 100 lot in the DAX or 100 lot in the FTSE, 100, 200 in oil. The market will generally move away from it to start with. Same if you get sort of 1,500 in bunds. So anything that's outsized. But yeah, that was a reasonable close. It at least has some range expansion on it. That's, in terms of size of close, that's actually one of the bigger ones. So 10 handles is a pretty big close. You'd expect generally on a normal day today, 2 handles maybe. Hence why you don't get everyone back in the office at 9 o'clock every day. The month end ones are generally the ones that are a little bit more, guaranteed's the wrong word, but you've got a higher possibility of there being a bit of a sort of 5-6 handle move. But that, on the particularly volatile days, that's probably as good, if not better, than a month end close, just because of the thinness of the market helps it out, and then everyone wants to trade because it's volatile. Volume was massive yesterday again. What was volume yesterday? Yeah, 3.2 million again in S&P, so double what you'd expect on a normal day. So yeah. Do we get the same again today? I don't think you'll get anywhere near as big today. You might get a slightly similar move, but I don't think it'll be anywhere near as big. I think it's going to depend on how volatile we stay today. If we have another go down and really go again, then I think today's close could be really, really good. But the chance of it going again today, I'm dubious. I'm dubious that you'd have 160 down, 120 up, and then go and break the low again. If it does, I think that's a sign that there's something really spooky in the markets, and people are going to start to really panic when they don't get the typical reversal like I mentioned this morning. So yeah, that's the S&P from last night. And yeah, once you've got your replays, then
isn't that on the close basically you can expect, I mean, yesterday was kind of a special day, but
a little
is
bit.
it more often that there is there are large orders around the close?
Yes.
Is it happening more often?
Yeah, definitely. You'll usually see a general build-up of size on the ladder around the close. Like I say, a general S&P close, probably not that notable. You'll have thousands bid and offer most of the time anyway. You might see a 2,000 on the close, so it's not, relatively, it's not that big a deal. When you see 2,500 when you can barely see a 3-figure bid or offer, it's quite a big deal. Month end closes, you get a little bit more sort of 5,000-6,000 coming in, so you do get a little bit more going on there. But yeah, that was pretty impressive for yesterday, and yeah, created a bit of opportunity. I should have actually come back to the office rather than try to trade it from home. Internet connection from home is not as good, so you don't trust it as much. But yeah, it was my turn for doing bedtime, so I got stuck with that one, unfortunately. So I blame my daughter for that. I'm missing out. But there you go. In terms of this morning, everyone found it all right? A bit more tradable?
Yeah.
What's everyone traded?
Less than yesterday.
Huh?
I preferred yesterday.
You preferred yesterday? For a man who was saying, I don't really want to do too much size on the sim because I'm not that comfortable with it.
No, but
You're quite comfortable with about the most volatile day we've seen since Brexit.
I was entering the trades and closing the positions with scanning out, scanning in. So it's
Yeah.
basically trading one contract in and out yesterday.
Yeah.
It was relatively okay.
So more sort of
Today-
scalping
Yeah.
type trades.
Yeah, and today too choppy for me. I mean,
Interesting.
At least for so far.
That's really interesting because I've actually thought today was a lot less choppy. I thought,
Okay.
I thought
Yesterday, I think the moves. I mean, it's also different products. So yesterday I was trading S&P, and today Bund more.
Right.
More S&P yesterday. and the moves were more extended compared to multi-memory today.
Mm. Oh yeah, definitely. I think yeah.
In aggregate it was choppy, but the range was a bit larger, I think.
Yeah. Yeah, definitely. I think that was the biggest challenge with the S&P yesterday. The not getting caught up in the too tight a range of what was going on. Sort of a 5-handle move was effectively nothing in the S&P yesterday. That was just part of the noise. And yeah, I found that quite hard because you're used to 5 handles being a reasonably decent sized move at the moment. And for me, it was just the way that it wouldn't sort of sustain anything. So say it would start to come off and you'd see it pull back and it'd go again and you'd think, right, well, this is now making a bit of sense. We've got a pull back, it's going. And then very quickly it would just trade straight back up.
Yeah.
And that's what I found very difficult yesterday.
The only, I think, a bit longer moment was a few minutes after the open, so we got this overextended move to the upside during the European session, and then we got some continuation higher, and then a bit stronger push to the downside. I think that was the relatively easier for me to play.
Yeah, I think talking to Samir particularly, who had a brilliant day yesterday, he was saying the S&P Open was the best bit because the fact it dipped and then it just found no more selling. As soon as it started to come up, that move up was sort of like 50 handles in about 5 minutes. Really clear to get on. I'm annoyed that we didn't quite wrap it up in time for that because it was kind of not predictable necessarily, but you could see that coming. If it didn't manage to drop and keep going, there was always a possibility that as soon as it reversed back through the open, it was likely to have that rush higher. So a little bit of a shame, but yeah, I thought today was quite nice. And actually, we'll just bring up a DAX chart just for a really nice example of trend line working very nicely. In that we got the move down this morning, we dropped into that range between 12,480 and 12,333. Dropped down to the middle of the range, created a wedge, failed the break to the bottom, and then we've held it perfectly once we got back in. Break up to the top of the range, back down, hold the bottom of the wedge again. So this is clearly the trend that everyone cares about. And then we've gone up once again. So just off that trend line, that DAX has given you some pretty nice little trades. I actually played this break here, and you sort of sat for 2 minutes, it just wouldn't go. I felt that once I got into the 25s, but once we got through 15s, that would have been the sort of point where it turns over and actually goes. But it just couldn't do it. And then so now, I think you've got to start looking at it in terms of this little pullback here could be an opportunity to buy back down towards these. Whoops. Unfortunately, you can't draw on these charts when they're on the board. Back down towards 75. If it holds there pretty much on that line where it is now, I think that could be your opportunity for a long to go up, and then really you're looking back up towards these highs up here. So you could still have another sort of 50 ticks in it if we do manage to do that. So yeah, nice example of trend lines from yesterday. All right, let's go and do some commodities. What we will do generally with commodities is stay with commodities we'll stay generally relating to gold and oil, just predominantly because of the fact that they're the ones that everyone trades here. No one trades soft commodities. In fact, I don't think anyone trades anything other than gold or oil here. There might be the occasional silver trade or maybe the occasional natural gas trade, but it's all gold and oil. There's one guy who works in an office in Canada who will occasionally trade gasoline as well, which if you want to have a look at gasoline, go for it. It's pretty crazy. It's and I've got a really nice example of, if you look at it over the last couple of days and it looks crazy, there's a really good example of how it is really, really crazy. Right. Oops. So really today, again, first week's just making sure everyone's on the same page. This, like I said yesterday, this is where it all started. So this all began in grain commodities back in the US. Farmers wanting a way where they could either hedge risk or make sure they've got their grain sold. And I was right, in fact. It was the 1840s, and that's when you got Chicago Board of Trade started, and they started with grain futures in the 1840s in Chicago. You either get physical goods, which is a spot market, or you get the futures. Generally, most people won't really look at the spot market because of the size of things you have to do within the spot market. So the main focus is all on the futures market. That's how most commodity markets are operated. That unlike say bond and foreign exchange and equity markets, whereby it is predominantly a hedging tool, futures markets are used a lot more for the actual delivery of the goods. So whilst you hear a lot about speculators in the futures markets in commodities, and you always hear that oil move through 100 and up to 150 was a speculative bubble, you've got to question how much it was, because all of the major oil companies are still using the futures to facilitate a lot of their trade. Got four main sectors for commodity futures. Like I say, we'll keep it to energy and metals, precious metals in fact. The middle ones, agriculturals and livestock. There is a vast array of different markets here. Pork bellies, frozen pork bellies, cattle, feeder cattle. There's things like timber. Interesting, there's no diamond future. None of that. That is kept very much in its own little market in Hatton Garden, and just, yeah, there's no diamond futures. I did read a few years ago the Norwegians were attempting to get salmon futures going. I've also had water futures, but no one's ever done water futures, which I think is probably quite a good thing. Certain things I don't think really should be quite as open to market forces as other. Generally, I think market forces will solve most problems, but things like water that is an absolute necessity for people, I don't think should. So yeah, like I say, we'll focus predominantly on oil, on gold. There's a variance in what people trade in terms of the oil contracts that they trade. And I think this generally comes from what prop shop you've traded at. Some places everyone trades WTI, which is US. Others everyone trades Brent, which is a much more sort of global benchmark. Despite the fact you always hear oil quoted as WTI, the main real oil market is Brent. Brent's made up of a basket of tons and tons and tons of different producers' oil. So you'll have Nigerian oil in there, you'll have North Sea oil. It all originally was North Sea oil to start with, and then it started branching out to sort of a benchmark of all of these different types of oil. Now, in terms of WTI I think is perhaps quoted a little bit more because of the fact that it is light sweet crude oil, and if you really want to read up into the specifics of things like that, light sweet crude oil is the best type of oil you can get. Light relates to its specific gravity, and the sweetness I believe relates to its sulfur content, which means it's more refinable or easier to refine. So there's different grades in terms of to have a barrel of oil that meets a specific grading to be part of a WTI basket. It needs to have a certain specific gravity and sulfur content, making it more refinable. So that's a more ideal oil. Brent sort of takes in a little bit more variance. Now, the other thing with oil, there is another sort of oil future you can trade. You can trade Oman crude oil as well, which trades on the DME, which is Dubai Mercantile Exchange. Slightly less traded, but that's the one that's watched a little bit more in the overnight session. So once all of America's gone home, it's Oman that generally will sort of lead things a bit more. Now, the other thing as well with oil is it trades throughout the day, and it is pretty much a 24-hour market like foreign exchange. But each of the different contracts, so WTI, Brent and Oman, all have their own specific closing points. So the close is basically the point where you get a settlement price, and that's the price that everything is then marked to market for on the futures. So if you hold a position and you hold it overnight, your position from an accounting point of view will be marked as whatever the settlement price is at these times. In terms of the times that they shut, you have the Oman close is at 9:30 in the morning, the Brent close is at 4:30 in the afternoon, and the WTI close is at 7:30 in the evening. Generally, it's the WTI close that's the one that gets the most movement. Gold, natural gas, the other two things that everyone trades. Gold is very, very much used for a risk-on, risk-off basis. So pretty much you hear some bad news, they'll be buying gold. And that's why if you look at a gold chart at the moment, because it's not been a news-driven move, you've not actually seen very much go on in gold. Whereas you get a comment, particularly lately regarding, say, North Korea, gold goes quite quickly. Good thing with gold is it's a very useful indicator in terms of if you have your ladders positioned whereby you have a gold ladder or a yen ladder, you use it for a risk on, risk off situation. So if you hear some news and you think, this is really bad news, but gold's not going up, maybe it's not as bad as you think it is. It's a reasonable, quick sort of way of deciding whether you should or shouldn't be staying in that trade. Likewise, if gold goes up and goes up and goes up and goes up, and you, for example, sold equities, probably worth staying in that. So, good barometer, similar to the yen. And that's the problem with gold as a commodity. Is it a commodity? Is it a currency? Is it just a hedge? And that's where I think day-to-day trading of gold can be quite tricky, because the factors that actually influence it. We're going to have a look at where the majority of gold actually goes. The other big influence for all commodities is their pricing. Virtually everything is priced in dollars, certainly on the futures exchanges at least. Therefore, you get a stronger dollar. Generally, commodity prices go lower because of the fact that for anyone who's not in the US, you've then got to spend more money to get your dollars to buy your commodities. So it implicitly puts the price up of the commodities. And we'll have a nice look at a chart of recent activity, dollar versus oil, and also recent activity, or not so recent activity, when you got the big dollar sell-off in 2014, and the impact that had on oil, and the other factors around that as well. Other big thing, geopolitics and OPEC. More an energy thing, this. You don't really see geopolitics affecting agricultural so much. I think predominantly because most geopolitical risk comes from the Middle East and they don't have a great deal of agricultural commodities or anything like that. So whilst that sounds like a massive generalisation, the majority of the soft commodity producing countries are in reasonably stable economies, i.e. Europe and a vast amounts of America. Big one that's still out there is North Korea. However, how much is this going to affect any commodities? The only commodity that's really going to affect is gold, because that risk situation. North Korea is not a big producer or a big user of oil. It's not a particularly populous country or a particularly advanced country. So the impact that will have on oil, on natural gas and anything else like that is reasonably limited. So moving away from geopolitics, that's the majority of, I would suggest, most people's trading here. It's those event-driven trades in commodities. There's not many people who are outright gold or oil traders. It's more a market for certain types of trade. Any of you guys intending on trading oil as the main thing?
Probably.
Yeah.
I like it. Yeah.
I think it's not a bad market. I do think it provides quite a lot of opportunities. Of the oil or gold, it's probably the one that people do spend a bit more time trading, sort of a bit more technically. Gold's very much a risk type trade. There's the occasional technical play that a few people like to do in gold, but yeah, oil. And we got oil numbers out today, so you guys can trade that at 3:30. So when we do the afternoon session, we'll run it until the oil numbers. We'll have a little chat about the oil numbers and about the implications of, do you know they do an API number and a DOE number?
Quite a big reaction last night.
Yeah?
Yeah.
Ah, there we go then.
50 ticks.
Wow.
Yeah, it's big for API.
Yeah, I was going to say that is a pretty decent move for API. Yeah. Could be quite an interesting one today then.
It's back below API now.
Is
API
it?
now, yeah.
Oh, right. So, yeah, it's a case of factoring that API move into the oil one. All right. So, supply demand, obvious next influence. And this is where you do have to have a little bit more of a macro view of things. But the idea of sort of substitutes make a big difference, and development of sort of countries. So, easiest example is China and pork bellies. As China became more developed, particularly in the early 2000s, demand for pork bellies went right up as they switched out of cheaper grains type products into more meat-based products. Shale gas as well. This is kind of a strange situation with shale gas, shale oil, in the fact that you won't see it produced until the value of oil goes over a certain amount because of the cost of production. And then the problem is, as soon as more of it comes online, it then lowers the price, which always makes it quite difficult to be a viable thing with sort of shale oil, shale gas. That's something that impacts Canadian economy a lot, because the fact that most of their oil comes and gas comes from oil sands, which is a lot more difficult to retrieve. So their cost per barrel of producing oil in Canada is more in the region of $60 to $80 a barrel. You go to Saudi Arabia, where they pretty much stick a spade in the ground and out it comes. Their cost of production is somewhere around $5 to $10. So they're always going to be able to produce, hence why OPEC can have such a big impact, because they're always the person who finds it easiest to cut supply or to increase supply and steal market share. We'll have a look at inventories in a minute. Soft commodities, and this is why you get those limit down situations with soft commodities, because the fact that they will spoil, they'll go off, and therefore someone will sell the futures to at least lock in some coverage, or have to just dump the inventories. And this is where you can end up with that limit down for 3 days situation. Cushing's the other big thing with WTI, and we'll talk about this in a little bit more detail in a minute. Cushing's a delivery point for WTI futures. Therefore, the supply of oil at Cushing is the most important factor on the price of oil, not the general supply in the US. And so we'll have a good example of this in terms of oil versus gasoline during the hurricane in the summer, because the fact that Cushing's a delivery point, the hurricane actually caused oil to fall, and we'll explain that in a little bit more detail. So again, if you're getting people pushing their oil into the delivery point, perhaps to take advantage of future prices being higher, you actually can then cause a drop in oil currently, because the fact people are more willing to store it, and so storage goes up, theoretically supply is higher, and then that causes prices to drop because the fact that theoretical supply is higher. All right, quick look at oil versus dollar. This was the 2014 run-up. So this was the point where you got the ECB starting QE. You got the Fed hinting that their next move, or well, this was the end of their QE program, so they would buy no more bonds after this point. And they'd also hinted that the next move was obviously going to be a rate hike. So you got big dollar strength in 2014. This coincided pretty much bang on with this big drop in oil. This was the last time we were up around 100. And so as soon as you got this sort of flag break and the break of these lows, coincided very nicely. Mid 2014, we were up in the middle here. Mid 2014 was pretty much bang on the beginning of that move in the dollar. So you see real strong correlation between the two. We have since though seen a reversal, and so this is what we got up to the end of 2016, very range bound in oil, and this is the key area just here. That's between $57 to $62. Real key area for oil, because the fact it has been traded a lot. We've seen a lot of up and down in this period. Once you get through that, that's where you can then expect a bit of a continuation higher, and it is what we are now getting. I marked it on the chart just there, 62, 61 as the top of that little range. And then what we've seen recently, dollars come off, but come off within its range. Had a bounce, started to come off again, and then you've got this extra breakdown in the last few weeks as well. So that's basically since the beginning of 2018. This is the beginning of 2018 just here. So you've got the sort of explosive move in oil, which has taken us up above that 62 area. But that initial beginning of the fall, this double top and turnaround in the dollar just here, coincided with the weekly breakout in oil. So it's sort of a double whammy. You got the breakout in oil, and that was helped by the fact that the dollar then did start to fall. So they helped each other out basically. So yeah, any time you're trading commodities, you've always got to be quite aware of what the dollar's doing in comparison. In terms of how you measure the dollar, you've got a couple of choices. You can either use DXY, which is dollar index, or you can use euro dollar, just because of the fact that the euro makes up such a large proportion of this basket that you're probably as well to use the euro. Little bit of a, certainly if you have the futures up, it's a more tradable product, so you'll actually see a bit more flow in euro dollar compared to dollar index, which doesn't have quite the flow in it. Much slower product. All right, so that's your dollar versus oil. Just a quick look at global supply, global demand, and where a lot of these things are consumed. Gold the big consumers, China and India, and this is a new thing. This is all to do with luxury goods. Gold's barely used at all as a manufacturing product. Previously, India was always the top consumer of gold, generally into jewellery. But like I said, the amount of supply-demand impact on gold, you don't really get a jewellery boom. I've never heard of anyone talk of a seasonal factor of coming up to Christmas and a gold boom as husbands go rushing out to buy jewellery. I don't think there is that situation. I have heard that in diamonds though, that you do actually get high demand for diamonds coming into Christmas and up until Valentine's Day. So if you are thinking of buying any diamonds, now is not the time. Leave it a couple of months and then go for it. In terms of agriculturals, obvious really, it's countries with the largest populations that are generally the biggest consumers. Biggest producer, Europe. Europe has a very skewed agricultural policy, in my personal opinion, in the fact that whilst they're the biggest producer, a lot of this is very subsidised production. A lot of this is production that perhaps doesn't need necessarily to be done. So in a way you get oversupply of agriculturals. Oil, it always seems that Saudi Arabia is the big one. US and Russia are actually the top two, which is sort of flipped one to another. And we'll have a look in a bit at how Russia has now decided that they're actually going to join OPEC, or they semi-join OPEC. There's this quite odd relationship where they're in it when they want to be, then they're not in it. And the reason for that, OPEC want Russia in because they're the biggest, or one of the biggest suppliers or producers of oil. Obvious, US consumes the most. Same with natural resources, US and EU. And coffee is in fact the second largest consumed and second most traded commodity going. You would think it would be oil. That said, there are so many different grades of coffee, so many different coffee futures you can trade, none of them are particularly liquid or tradable, which is a shame. But there you go. And this is where you do get a total difference, that it all comes from South America, who don't have quite the level of cartel organisation that you would see in oil. So you could argue coffee's a bit of a freer market. And then it's obviously all going to the first world, because everyone in Europe does love coffee. In fact, they've nearly double the US, despite having basically the same populations. So I blame the Italians. They love coffee. In fact, it's more the English. Well, it's mostly English now, I think. So yeah, just a general sense of where the gold goes. Germany is a particularly big consumer of gold. Probably to do slightly with the manufacturing. Germany also holds some of the largest gold reserves out of most countries. The majority of countries don't actually hold a great deal of gold anymore. Germany does, and keeps theirs at a reasonable level. Alright, so next thing, global demand. Not really seeing this global demand having too much impact. You could argue it in recent years as countries are coming out of the crisis. You're seeing commodity prices rise generally, certainly in the last sort of year to 2 years. Take oil, for example, has moved off the lows. A lot of metals have moved off of recent lows. Best example, though, I'll show you a chart of the 2008 recession. Basically, as soon as that set in, that was the break of oil below $100. It was, in fact, the day Lehman Brothers went bust, oil dropped below $100, and it never came back. Well, it did a couple of years later. It dropped all the way down to 30. Then it got back by 2012, 13, 14, and then we dropped once again. but it was that breakdown pretty much on that day, which was effectively the flipping point that was like, this is now definitely some bad stuff going on. Oil dropped, and oil dropped straight away to $32, which was, from a technical point of view, a very nice area, from the fact that that was the bottom of consolidation before the very, very strong move higher. Use the previous example with China and their increased GDP, increased development, increase in demand for industrial commodities. This is where you saw a big boom in copper going into 2008, which then, as the slowdown seeped into China, copper then started to get hit as well. So the drop into 2008-9 in copper was as much influenced by China as anything else. Substitution effect, as we mentioned, luxury products in China and India as well, and then the sort of switching pork belly. Everyone heard of driving season in the US? Yeah, it's May to September, I believe. These quite big impacts on particularly gasoline. And this, again, we'll show you the example in a minute, but this is where you get a gasoline increase, which doesn't necessarily mean there's going to be an oil increase. If there's an oversupply of oil, then you just see a drawing down of oil, and then it's the extra demand for gasoline. So you get this sort of seasonal spread between gasoline and oil that moves more perhaps than the actual oil price itself. It seems nice and easy. You go, all right, it's May, buy oil, it'll go up for the summer. Generally doesn't. You're going to have to look more at a spread trade between the two. Chinese New Year creates a lot more spending on luxury goods, but as I say, I don't really feel that there's that much of a sort of drive into luxury goods during Chinese New Year or during any of the other sort of religious festivals over towards the Far East. Right, so we're going to have a quick look at a couple of charts here. This was the 2008 drop. Got GDP starting to fall in June. Oil peaked in July 2008. You look at this on a chart, and this is the kind of thing that I didn't really look at back then, but you got an absolutely lovely hanging man on a weekly there. So if you wanted to be bearish, that was a perfect week to be bearish. And again, going on to that point that I've made before, I do think the charts give you a pretty good indication of what's actually coming. And so as soon as you got this beginning to drop in US GDP, turns negative in September, and that's where you then get this move down here, and we really start to come off. This move on this big spike up, that was one day, and it was in about 15 minutes. It was on the WTI options expiry. Someone had a large option position that they needed to get out of, and it jumped $20 in about 15 minutes. It was quite some move. Unfortunately, I wasn't there to actually see it. One of the guys in the office was talking about it. It was just crazy. You couldn't see any bids and offers on your ladder. It just jumped and jumped, and every so often you just see a bid, and then it'd go up, and then another bid, and it just keep going up. But yeah, $20. So someone got very, very hurt by that move. Unlucky for some, but that's what happens if you don't hedge out your options positions, or you suddenly realise that you have got a massive position that needs hedging. And then the oil low was hit pretty much bang on the low in US GDP when US GDP hit minus 8%. So it was a serious drop in US GDP. Oil got down to a low, got down to $32, which was, if you go back on this chart, in fact, the low down here as well. So basically double bottomed, and then we got the rally into 2010 back up towards 80s, and then all the way back up to I think we got up to 120 as a peak in 2013. But I remember at the time as well talking to one of the other guys saying about, or sort of after this, talking about the difficulty to actually make £1 million in trading, in that to do it, you would have had to sell a 10 lot in oil and run it for the whole move, which would be, to see that coming from 150 down to 30 would have been quite something. Hence why you do need to build your size up if you do want to try and make that kind of money, because you're not going to do it by running a small position for a long, long way, unless you have got a very, very, very strong opinion of what's going on there. But I don't imagine there's too many people called that at all. Interestingly, this was where you actually got another dollar move as well. You got a lot of dollar strength, despite the fact that the US GDP was falling out of the sky. There was a big shift into dollar because people wanted the safety of owning T-notes, and that had a pretty big impact on oil as well. Dropped oil. Also, I think GDP was probably the bigger influence here. All right. Okay, so global supply. This is the flip side of things in terms of where all the price impact comes from. And there's a distinct difference between supply and deliverable supply. And this good example of this is provable reserves. So countries that produce oil, we'll use oil as an example again, have a provable reserve. So basically they can say, we have got this much money, this much oil. However, that has no impact on the price of oil until you can actually deliver it. So if it's not there to be delivered, it doesn't have any impact. It's a little bit like a build-up of supply at a hub or at Cushing. That is then deliverable supply. That will have an impact in the sense of pushing oil prices down. As that supply gets delivered, oil prices then rise back up because the supply is now out there. People have taken the supply on and now they're running out of supply. Anyone know who's got the biggest provable oil reserves?
US.
No, Venezuela. And yet they are hardly a rich country, and it just goes to prove where they're going wrong. They spent a bit more time drilling for oil and selling it, they might be a little bit better off. But yeah, they've got the largest provable oil supply in the world, over Saudi Arabia, the US, Russia, all of them, who you would assume probably have by the virtue of the fact that they are the biggest producers. But they are not at all. As I was mentioning, yeah, it's all about the amount that's been produced and stored. We've already covered soft commodities, Cushing inventory, and price-related supply. Talked about shale already. Simplicity makes a big difference, and this I think could have quite a big impact on the energy markets going forward. The fact that electric cars were actually made before combustion engine cars, but it was the simplicity of production of the fuel which meant that it was actually combustion engine cars that proliferated in the early 1900s, not electric cars. And that's just by virtue of the fact that you couldn't build a battery big enough to put in a car at the time. The weight of the battery would prohibit the car working, basically. And so this, I think, could now start having quite a big impact on energy prices if they can make these things more efficient, and also regulatory costs. That's becoming a major impact on the majority of energy-related commodity products. As you get more sort of green regulation, you're going to see more shift towards cleaner fuels and batteries, etc. And this is where you then could see a further shift away from standard sort of fossil fuels, I think could have reasonably sizable impact on oil, particularly coal and things like that. I think they're the ones that are going to get really hit. One thing that I think it came out earlier this week or last week, there is a new sort of area that is being opened up, is China are now permitting the trading of their iron ore futures, which is something that they'd not done previously. China iron ore futures are massively traded. There's a huge market for them. So that coming online, I think, could be quite a good market to trade because of the amount of liquidity in it, because of the fact that, without wanting to sound disparaging to the Chinese, there's going to be a lot of people in that market that have never traded in a global market, and so I think there could be quite a lot of inefficiency in the market. Of course, as soon as it goes to the wider world, you're going to get a lot of market making come into it. It should theoretically very quickly become more efficient. However, I do think to start with, it could offer quite a lot of opportunity. So I will be watching out for the point when we can actually trade Dalian iron ore. I think it could be a very interesting market. Sorry. No, so I just thought there was a bit of news come out on my news feed, but not majorly important.
Oil had a big drop like last few minutes.
Oil?
Yeah.
It's testing quite a big low.
Okay. I'll get a quick oil chart up for you. There we go. Oh yeah, just about through it, aren't we? Yeah, that's quite a nice little trade there in oil for that breakdown, because of the fact you've got the obvious low down here, but you've then got this smaller low here and then another low. And what I'll often look for in a trade, if you're trying to play this break to get in early, is you've seen this low, so you've almost now got effectively a little zone here that you want to get in at, because you're expecting the breakdown now. You've come up, we've consolidated, we're effectively just sitting in a range. Broken down from the overnight moves, and that's where you can now start thinking, right, we've got this little range here of about 10, 12 cents to be getting in. You get the first dip into the range, and that can catch people out the first time. Drops in, gets a few people short, you get this quick bounce back up. Therefore, as you take this low out, you're now already into the box, you're now back below this low. That's where you can start looking to try and get in before the breakdown and try and be in ready for it. I don't know quite how big a level this is.
Comes back a bit.
No, chart. Oh, yeah, quite a decent little level.
It's 280.
Yeah, so I'd suggest if you can break that low at 63.05, that's where you can then really, you got 62.78 as a target. And then below there, you've not got a great deal until 62.50, so yeah, you could end up sort of building this range here. Oops. Building that as a bit of a range. So this could be your sort of last chances. So either you're going to take that out, and that's 62.78, and continue the move lower, or you could end up with getting a bit of a bounce here, and then it just drifting back up into that range. So quite an interesting area. Where are we currently trading?
63.10.
63.10. So yeah, just sitting below that level. I guess if you're in, and this is where that getting in early makes a big difference. So if you've managed to get in this little gap here, at worst you're probably going to take a scratch. Whereas if you sold it on the break and sold 63.12, 63.10 area, it's now getting a little bit sort of tense, and you're starting to doubt whether the trade's going to work out. And ultimately, if it's not going to work out, you are definitely going to take a loss, because you can't take a loss before it goes back above 63.12 really. So yeah, nice little breakdown in all of there. You've effectively got a little wedge, haven't you? That we've broken out of. Yeah, we shall see. We shall see. Could be turning around everyone from that API number yesterday as well, if everyone got long on it. Turn them all over. Right, we will have to wrap this up by 11:30, just because of the fact there's the mental session which Brown is doing. Yeah, Brown is doing it. Yeah, okay, cool. Well, give a little time for setup there, and then you guys will be able to message Brown, ask him anything that you want to know relating to his mental session. Right. Quick look at Cushing inventories. I mentioned these already, and this coincided with that big dollar move in 2014. But at the same time as oil sort of started to break down, you got this massive build up in Cushing inventory as people stored oil, and so this storage of oil then served to perpetuate the fall because it increased deliverable supply. You then theoretically got no reason to buy oil now, because you know there's a massive supply of it in the future. There's no point in buying it now. You can buy it cheaper later on, and that sort of helped out this large move lower from October 2014, and that was pretty much as you got the breakdown in oil, which is at the same time as that push up in dollar. You then saw people starting hoarding oil and production of oil going up as well, which sort of ruined the oil price somewhat, increased it back up. So yeah, that's Cushing versus WTI. It's now, that I think could have well have been the peak in Cushing in terms of the highest the inventory's ever reached. Next up, you've got weather and geography. That's the big one in terms of oil, and this is what I was getting at when we were talking about gasoline earlier, and understanding where all of the refining is in America. So if you are trading oil, knowing where all the refining is pretty important. This is the big area. Down on the Gulf Coast in Texas, there is a lot of very, very big refineries. In particular, in terms of if you're listening for news, Corpus Christi and Port Arthur are probably the two largest refineries down there. I can't remember who they're both owned by, but they're owned by people like Shell and Exxon. They're the two really, really big refineries. And so that, if you do start getting any kind of weather-related impact in that area, is going to have a very large impact on oil and gasoline. Gasoline a lot more so. And just to give you a little sense of what's going on here, this is the hurricane. This was Hurricane Harvey in August last year. Comes up through the Gulf Coast, hits bottom of Texas into Louisiana. Didn't quite go as far as Baton Rouge, which is one of the other large areas of refinery as well, and New Orleans. New Orleans, not so much oil refinery down there. And so what this served to do was cause this massive spike in gasoline versus crude. So that's what you refer to as a crack spread, the difference between the crude and then its what's the word for it? That's the word. Derivatives, yeah. And so what you got is you got a massive bid up in gasoline compared to crude. You also saw for a couple of weeks, and this made the crude inventories really interesting to trade, because you were getting a big build up in crude inventory, and at the same time you get a big drawdown in gasoline. So for the weeks coming, well, for the week of the hurricane and then the ones afterwards, the gasoline number was actually becoming the big number on the Wednesday DOE numbers, because of the fact that initially you would get a reaction off oil, you would then get the counter reaction off gasoline, because you were seeing huge drawdowns in gasoline, much bigger than expected, as you can see, and as you can see there. So the blue line is the expectation, the orange line is the actual. But then what you did know is that you were likely to then start seeing the build, the build in crude dissipating. So in coming weeks, you'd not be surprised if you saw a drawdown in crude inventories. And so you can then start adjusting your strategy to not really be playing to buy oil on much of a drawdown, because the fact you know that's coming, and the reason it was coming is because you got this very big push of inventory build as everything that went to Cushing stayed at Cushing. It never sort of went down to the Gulf Coast to get refined, and then the gasoline storage got drawn down massively because the refineries weren't online. So as soon as they went offline, all gasoline at Cushing, they just got taken, and it all went to, well, it didn't go to the refineries, but it went to wherever the refineries would have sent it. And that caused this massive spike, and then the opposite, and it all came back the other way. So you had about 3 or 4 weeks where the gasoline number was the number to be trading, and offered an opportunity in that the market still almost always reacts to the oil number first. So you'll get the move on oil, and then you're looking at the gasoline number, you get the opposite in that, and you can go back the other way. So that produced some quite nice trade opportunity, just over that August period, and then in the few weeks afterwards, as this started to come back down, then once you got the spread sort of back to more regular levels that it had traded at for the year, we then sort of slowed it down. You didn't get such big impact, you didn't get such big movement based on the gasoline number. And in terms of what they did individually, that was gasoline when the hurricane made landfall. Now gasoline, in terms of its pricing, is 0.4 decimal points. So it effectively moved from down here 7,500 up to, up to 2,200. So you basically got a 5,000 tick move in gasoline over those 3 days, particularly on this one final day, which was around about a 3,000 tick move, which is pretty sizable for any market. And then, unfortunately for some people, a massive gap down. So you got a big gap down. Same time, oil drops for those 3 days and then turns around and goes back up. So you almost just had the complete opposite trade, and all of this was based around a spread trade, basically.
I thought it was also there was no demand from the refineries for the crude because they couldn't refine it.
Yeah.
So the demand for the crude had gone down.
Yeah, that as well. Hence why you get the increase in Cushing levels and the increase in inventories. But yeah, completely, because they're all shut. You can't do anything.
Yeah.
And then oil drops, major ramp up in gasoline. You could trade it as a spread if you wanted to. I think quite a dangerous spread, because the fact you've got to trade this as a spread, you've got to factor in different tick values, the volatility in each, I think you're always going to end up with a slightly skewed situation of probably being overexposed to gasoline, just because the fact it is moving so much more. So even if you play the spread, you're effectively playing gasoline, because that's the one that's swinging the spread. It's not really the oil that's actually doing it. Oil, yes, is coming off a little bit, but it's the gasoline that's really swinging it. So you would ordinarily, I think, trade the spread as 2 or 3 to 1. So you trade 2 or 3 gasoline to 1 oil. You probably have to flip that over in this situation, because the fact that it's gasoline's moving so much. But yeah, that was what we got in August, and then once we got back to normal, those DOE numbers that were coming at 330 started to have a little bit less impact. All right, geopolitics. It's all about OPEC really with this. There's not a great deal of other major impact on oil prices. You look at, say, Syria, and that's not had too much impact really, because the fact that Syria is not much of a producer. The only thing that Syria does have is quite a large port, and if their port gets stopped or taken over, there is a risk that the oil, particularly from the Middle East, can't actually come through that port. So that's still potentially a little risk factor for oil, but I think the fact that the problems in Syria have gone on for too long that anyone's going to be too worried about it. The other big area to watch out for is anything on the Strait of Hormuz, which is the little bit of land between Saudi Arabia and Iran, Iraq. So you go and have a look at a map. It's effectively the bit of the Saudi peninsula that's got sort of Dubai on and the Emirates. That little area, Strait of Hormuz, is where all the oil comes out of Iraq and Iran on ships. So if someone decides they're going to close it or stop shipping through that area, the impact on oil is going to be pretty big. And I think Iran tried to do that in about 2013 when the sanctions first went on relating to their nuclear program. And so to counter those sanctions, Iran said, right, we're going to shut it. And it was round about $1 move in oil, sort of straight off the news. So it was one of those that preparation makes a big difference for that. At the time, you sort of heard it and you're like, yeah, that might make oil go up, but you're not sure how far, because everyone's scrambling around on Google Maps to work out where the Strait of Hormuz is. That's where it is. Obviously, it's a major shipping lane out of that region, so big impact there. OPEC decides on their production levels. Obviously, this isn't global production, and the fact that you've still got the United States, who, sorry, this is slightly old, have actually now moved back up towards the top of oil production, is still quite high up, as well as China and Canada. Does mean that they don't have quite the influence that they perhaps did 20, 30 years ago, when there was a lot less production from non-OPEC countries. Last time they cut was November 2008. What they basically did was reduce their supply by 1.8 million barrels a day. They'd allowed Iran to increase their production once their sanctions were lifted. So basically Iran wouldn't agree to the deal unless they were allowed to move their production back up to previous levels. We then got, last year, this agreement was then extended till end of March 2018. So that's basically the next period that we're going to be looking out for. Any kind of comments from OPEC coming into March as to what they're going to do with these production changes. Officially, their next meeting is not till June, but you're likely to have something out of them to explain what they're going to do with these production cuts. Are we suddenly going to see a big supply of oil coming straight back onto the market in March? If you don't hear anything from OPEC, that's going to have to be the assumption, which could then start pressuring prices globally. What was the other big thing that I wanted to point out about OPEC? The fact that Russia has joined them as well, and that's making quite a big difference. That's where any of these OPEC plans could end up getting scuppered if Russia decides that they don't want to be part of it anymore. That's where they could come unstuck a little bit, because of the fact that Russia is the biggest or second biggest at the moment. Their impact on OPEC decisions, on OPEC's ability to impact supply, impact prices, is quite significant. So we'll see how Russia manages to continue going forward with their sort of relationship with OPEC. Names of note, Barkindo is the Secretary General of OPEC, so anything from him is generally reasonably important. What you do get with these OPEC meetings is you get a huge amount of speculative chatter beforehand. One oil minister from one country will say that they're going to cut production, one will say no, we're in agreement to do this, another will say Russia's on board, another will say Russia's not. You get a huge amount of very confusing comments going into these meetings. Hence why I feel that unless it comes from one of the big names, it's almost a bit more dangerous to try and get in on that comment. So Barkindo is the main one. He, I believe, is Angolan or Nigerian. So he's originally the oil minister for one of those two countries. Angola is a very big oil producer, very rich country now based on oil, as is Nigeria. Al-Fali is the Saudi oil minister, so obviously probably the most important one in OPEC. Ultimately, OPEC decisions come down to Saudi Arabia, or certainly they will have the biggest influence on decisions. There's not many decisions that will go through that Saudi Arabia doesn't necessarily agree with. So he's the other big one. And then Novak from Russia, who is obviously going to have the big say on whether they stay in or out, unless President Putin decides he's going to join in with some commentary, which he could well do. So yeah, just for a little bit of an understanding of who's part of OPEC. Their meetings coming up, they generally have a big meeting in November as well, so that's the real big one. So yeah, we'll keep an eye come March. I think with any of these things, it comes into fashion, if you will. So OPEC is likely to come back into fashion in March. I think until then, we've got a little bit of time to wait for anything from OPEC. Now, in terms of geopolitics as well, and it's all about understanding what market is going to impact. And this was the Crimea annexation. Basically, this all started with Russia not wanting the Ukraine to sign an agreement with the EU, and Russia then threatened sanctions and military response in Ukraine due to the agreement being pretty bad for Russia, basically. You then ended up with a situation of, are Russia taking control of Ukraine? Is Europe then going to put sanctions on Russia? Because sanctions on Russia have a big impact on Europe, because of the fact that Russia supplies such a large proportion of European gas, and the other impact is virtually all of it goes through Ukraine. It all goes through pipeline, pretty much straight away through Ukraine. Down here, that's basically the way it does it, across the top of the Crimea. Russia has since sort of said that it does want to build various different pipelines, and that's part of the reason they've got quite an interest in Syria, because of the large port in the Mediterranean that they could pipe straight through to the port in Syria, and then they could ship gas out from there. But at the time, everything went through Ukraine. That was the big impact, and so the focus then came on not gasoline, natural gas, and that was where every comment on sanctions, every comment on Russia taking over Ukraine, Russia not taking over Ukraine, created a very, very whippy natural gas market. Virtually no impact on oil at the time. And then what you did get is this buy the rumour, sell the fact situation, whereby as soon as Russia took control, despite the fact that that was perceived to be quite a bad ending to the situation, ultimately gas supply was going to be restored because Russia would now have control of Crimea. Russia controlled the supply of gas, and so they were happy. They continued to supply gas. The fear then dissipated and straight back we came. So yeah, just a little look at geopolitics. We're not really seeing too much going on in terms of natural gas and oil geopolitically at the moment, but once we do start seeing it, if we do start seeing it raise its head again, I think the big risk area at the moment is Saudi Arabia and the recent new crown prince who's then come in and started putting his cousins in jail, and how much of an impact and destabilising factor this has in Saudi Arabia. If it does, you could then see either a shift in OPEC to massively cutting production, Saudi Arabia potentially leaving OPEC, which you would think would create a much more freer oil market, Saudi Arabia equally ramping up their oil production to try and capture a lot of market share, potentially if his aim is purely to enrich himself at the expense of cousins, other family members. Massively increasing oil supply in Saudi Arabia could be a good way to do it. It might push prices down, but if they take a huge market share, you're then seeing quite an impact there. So I think Saudi Arabia is probably the big next risk area geopolitically, but we've got to wait and see if anything does manage to come out of that. That I think does wrap it up on commodities. So what we'll do is we're going to have a quick look at these oil numbers for tonight. Well, I say tonight, but later on. What I'll do is I will leave up the economic monitor for you when your numbers come out. Right, there we go. So that's what we got, and we'll get an oil chart. Right, so is that the API number? No, that wasn't. That's the API numbers from last night. Pretty decent build, I'd say. What were the API numbers?
Is that a draw?
1.5. Build 1.5.
Yeah, they're expecting a build of 3.2, got a draw of 1.1. Gasoline. Yeah.
On the API.
Yeah. Minus 1.1 versus 3.2. OPEC satisfied with 2017 oil price gains. So, yeah, we got minus 1.1 draw compared to 3.2 expected. So 4 million draw, reasonably decent sized draw. And so what I try and do is always factor this into the oil numbers for the day. You also got 0.2 on the gasoline. Distillates a little bit less well watched. Distillates are heating oil. If you did want to trade distillate number, you trade that in heating oil, which is HO on your TT. Gasoline, incidentally, is RB for RBOB gasoline. I can't remember what RBOB stands for. Something refined, something. Sort of quite a complex name. But yeah, so we've got jump up of 39s up to 80, so about 50 ticks in 3 minutes. Well, the main move, was in these 3 minutes, so 40, 50 ticks up. What we're expecting today is a build of 3 million. Because of the fact that we've got this decent drawdown, I'd actually shift my expectations on this a bit. So my expectation really of this crude number would probably be, I'd probably change that to 0 and view it as, if we get a build, then I'd expect oil to come off. So any build, I would expect oil to come off. Drawdown, equally any drawdown, I would expect it to rise, but not by quite as much, because of the fact that we got the drawdown yesterday. The surprise element is going to be the build today, basically just going completely against the API number. Keep your eyes on gasoline. Like I say, that was 0.2, is expected 0.5, so gasoline number I would call pretty much bang in line, so I don't think that's going to have any impact unless gasoline today is wildly out of line with what you get from the crude number. So the crude number for the focus today, 40-50 ticks seems quite a decent move for an API number as well, and the fact that we have since just completely given this back and we're now trading down towards the bottom of that range sort of shows that the market is not willing to hold on to those gains. So a build, one, will go contrary to the API number. Two, I think you should probably get that break down a little bit more back into the range and a bit of a drawdown. Then I think you'll get a push back up into the range, but I think it'll be a little bit more short-lived. If we actually break down beforehand, then it's going to change the way that I'm going to look at it a little bit. If you got a drawdown and a move back up, I'd look at that as an opportunity to sell, to continue that move lower and continue the sort of move down towards those prices we talked about a little while ago. So for me, the risk here is, or the greater move is likely to be a move to the downside. I wouldn't be overly keen on trading a drawdown unless the draw is, well, I'd always give it sort of 1 million one way or another. So unless the drawdown really is bigger than the API number, I don't think there's much of a buy in that at all. You do get them occasionally. You do get the real outlier of the 5 million draw, something like that. But you do have, and this is where the draw could come in a little bit, every single expectation is for a build. There's not one person who thinks it's going to be a draw at all. So that's where the draw could be a little bit of an outlier. But the fact API has already got there makes a bit of a difference. It's a shame nowadays that the API comes out in the evening. You used to get the API number about 10 seconds before the DOE number.
Oh, really?
Yeah.
Oh.
Which was good in the sense, basically what you would do is have a wide parameter on the API, so you go, right, that you wouldn't get an expectation of the API number either, so you just get this 3 million here, and you go, right, if it's 3 million either side of that, I'll get in before the DOE number. So you go in on the API number and hope that the DOE number put you on side, which if the API was big enough out of line, generally would. And so you'd be in first and it would ping you perhaps like 50 ticks on side. So yeah, that made it a lot more entertaining. We've looked at getting the API number so that people could trade it, because the fact that moves do now seem to be more on the API than on the DOE number. However, having looked into it, it's a very, very costly number to get. I can't remember, it was something like, it was $25,000 or $35,000 a month. Yeah, so even split between 12, that's still $3,000 a month. You've got to be pretty certain you're going to make money on that to be willing to pay that. And you know, if you get a month where it's in line every time, you're not going to make your money, and then it just becomes a massive cost to everyone. So I think the general consensus was it's not worth doubling everyone's desk fee to have a punt at 9:30 at night on an API number. I think probably a wise choice. But yeah, there you go. Right, we probably best wrap it up there because I know Brand's starting and I think we need a little bit of time to sort of get stuff set up. Anyone got any questions on commodities, on anything?
Can we trade Brent on the TT?
No, because it's on ice. So yeah, WTI. WTI's the one I've always traded.
It'd be interesting to watch here.
The spread between the two. You might on CME be able to get a Brent WTI spread.
Okay.
So you could have a go. There might be CME Brent, but if there is, it will be very thin. So yeah, type in Brent and see what you get. Any questions online, Paul? No? Everyone happy? Good stuff. Yeah, so if we've got no more questions, we'll wrap it up there. We'll do currencies this afternoon. Again, just pretty much an overview, so apologies if you all understand all this and it's a bit of a slow week, but we'll make sure everyone online's up to scratch. And then we'll do Bank of England tomorrow, so change it up a little bit. Do Bank of England, and then we'll obviously all trade Bank of England, so I think we'll start slightly earlier tomorrow, perhaps start at 9:30, so that everyone's ready for the Bank of England when it comes out. All right, I'll catch you guys online in an hour and a half or so, and you guys I'll see here for the next little while. Right, see you in a bit.